Hey, Doug.
Hello, Sean.
So today we thought it would be good to talk about, especially in this economy in these days, so many people are self-employed. Is there any difference between getting approved for a home mortgage if you're an employee or if you're self-employed?
Alrighty, good. So number one is that want to reemphasize again. This is a little bit of a repeat from some other videos, but we're in the fall of 2010. Interest rates are historically low. In fact, I believe the date is around 1950. They haven't been this low. So if you're thinking of buying or maybe refinancing, this is probably the time to do it. Now, the difference between getting a mortgage when you're self-employed versus when you have a regular job or what we call W-2 income. Strictly speaking, there is no difference as far as the mortgage company is concerned, because you've got income and you've got debts. And that's what they look at is not only your credit rating, but the ratio of your income and your debts to that income.
Okay.
But the difficulty or the little bit of a nuance comes with self-employed people because their tax returns are quite different than if you just have W-2 income. On a tax return, you have W-2 income, and basically that's what they use. So we're going to talk a little bit about income here for a self-employed person or a person who owns some real estate investments where you have a profit and loss on a rental.
Okay.
And a rental unit, apartment building, a single family house, whatever.
And this would apply also, if it's just a spouse. They say, oh,
Right.
well, I'm a W-2. It's like, well, yeah, but if you're both trying to qualify for the loan,
Yep.
you're going to have to jump through all these hoops.
Right. And so if you need income from both parties, and one is self-employed or both are, so just a couple little pointers is that the mortgage company is going to need in a lot of detail about your situation. So you're going to need a really good profit and loss statement. You're going to need a good 2-year history of your profits.
Okay, what if you don't have a 2-year history?
Then that's tough. So we want to make sure that.
So if you're self-employed or you run a business or anything like that for less than 2 years, going to be tough to convince a bank to give you money.
Right. They want a 2-year running history. And the same thing it would be if you're counting income from income-producing property, rental properties, for example. They're going to want to see a 2-year history of that. So what you need to do is just have everything prepared in detail and to make sure that you've got, for example, the one person I talked to the other day has 5 rental properties. And so what you need to do in that case is you have to match up every property with every mortgage you have on that property, if you have a mortgage on the property, along with you've got to have supporting evidence of everything. So you got to not only match up the mortgages to that property, but also like insurance policies and everything. So when taxes, so when the underwriter looks at it, yes, you have that information reported on your income taxes, but all the other information has to match up. So they're not only looking at your income taxes, but they're trying to match everything else up that they see. So here's a mortgage from XYZ mortgage company. What property does that mortgage belong to? They want to know those specifics.
And Doug, when you're saying you said the underwriter.
The underwriter.
And just so everybody's clear, the underwriter is not the loan officer.
No, the loan officer is collecting information and starting the process. But it really helps to have everything in the loan officer's hands and have it as detailed as possible so that when the loan officer transfers all that information for an underwriting analysis, it goes smooth and there's not many questions left unanswered.
And the underwriter is kind of like the research person sitting in some office somewhere normally,
right,
like in a big building for the bank somewhere, and they're the ones who kind of have to sign off that,
right,
yep, I've reviewed all these documents, and it looks like this person is going to pay back this mortgage.
This person's application financially meets the guidelines that are set forth for the mortgage program that we're doing.
Right.
And so it's that underwriter's responsibility to make sure that it does fit all those guidelines, and then they sign off on it. And you might have heard in the news today, like Bank of America and maybe Wells Fargo, they might have in times past cut corners in that process and said, well, nobody was really going to care. And now people do care because there's foreclosures going on, and so the government and the Federal Reserve and such are looking at how they underwrote those programs, and if they cut corners and didn't match everything up just the way they were supposed to, they might be asked to buy these mortgages back. So,
and a lot of people don't understand that, but actually the banks normally don't hold the mortgages, then they package them and sold them.
Right.
On the stock markets, they might be forced to take back those mortgages that they didn't underwrite properly.
Yeah. And so it's kind of like a hot potato. So what's happening now is kind of the backlash of that, is that the underwriters are being super, super careful because they know what happened in the past, and now some of the mortgage companies are getting burnt on their procedures that they were using before, which weren't maybe quite as they should be. And so now they're being super careful and probably going the opposite way. So some people that are self-employed are having harder times. Even some employed people, if there's anything abnormal in their tax return or anything abnormal in their employment history,
are like we talked about. We talked about like if you if a big portion of your income as an employee is a bonus.
Right. Bonus, overtime, those things.
Yeah, overtime, people forget about overtime a lot.
Right. So those are just some things you have to be aware of, and make sure you get good advice from your real estate agent and your loan officer. Say, now, do we have enough information so that we don't have to keep coming back and forth and have a lot of questions answered? Because if you're on a timeline trying to cash in on a good rate or get this house and you told the seller you'd be closing, you don't want to have these little hiccups happen that would delay the time frame for your closing.
So get all of your accounting, whether it's for a real estate investment, rental property, whatever, or if it's for a business that you own or you're self-employed, have all of that done ahead of time. Just good to have those books, income and expenses, and what are those details are, I suppose.
That's great. And just on a side note, I just thought of this as not something maybe we talked about covering in this video, is that some people who are self-employed, their tax returns probably are being minimized as far as on the income side. And so it hurts you when you go to apply for a loan because now your income is maybe lower than what you feel you can support for a mortgage payment. And in those cases, I would suggest waiting to buy, and refinance is out of the question, of course, probably. So maybe you want to just buy on a contract for deed. A lot of sellers these days are willing to look at that. And if you've got good solid credit and you've got proof that you have a viable business that you're running, most sellers are happy to, they don't have any guidelines to follow. So it's just personal preference on how they are handling a contract for deed, but that might be a way to look at trying to buy your next house.
Great. Thanks, Doug.
Okay, thanks.
Appreciate it.